All right. So chapter 3 quiz, we're going to take a review. We're going to take a look. I'm going to share my screen and we're going to walk through the answers that go with that. So let's take a look at what the quiz was about. 6 questions and all relating mostly to, or mostly relating to, all relating to chapter 3, mostly adjusting journal entry stuff. So let's go take a look. Retained earnings. Here we go. Everything back. So the first question on the quiz is a retained earnings calculation. Nope, I take that back. First question, by the way, the questions are randomized. So if you're texting somebody, say, what's the answer to question 3? And they say C, you're probably reading a different question. And if you say, what's the retained earnings question? They also randomize the answers. So if they say B, yours might be D, so don't go there. The numbers are going to change to protect the innocence as well. What's going on here? We're giving you straight a number. We're not telling you it's $1,000 a day and there were 3 days left in December and 7 days left in January and how much you got to calculate. All we have to do is figure out $9,800 worth of employee salaries. And what we do with that, we're going to put in 2 places. So we get $9,800. The best way to answer these kind of questions is actually look at the journal entry and say $9,800 to debit, $9,800 to credit. No cash. We know that's the first rule. Second rule is one balance sheet account, one income statement account. So what are we going to do? Do we debit the expense or do we credit the expense? So the answer is debit the expense. In this case, it's going to be wage expense. I'm sorry? The debit always goes first. Okay? And sometimes we might be reducing the expense, but in this case, we're increasing the expense. 98% of the time, yes, it will be going first. The expense will go first. But that's not the best way to think about it. The best way to think about it is, okay, I've got 2 accounts. I've got a balance sheet account and income statement account. If I'm affecting the revenue, I've got to credit my revenue. That's my revenue is usually going up. If I'm affecting expense, I got to left it. I got to debit it. So my expense is going up. In this case, we're adjusting the expense for wages. Is this an accrual or a deferral? Is it an estimate? Do we already pay somebody? Or are we just picking a number and saying, here's what we think the amount of wages are? That's the latter. So we basically said, I haven't paid anybody yet. I'm going to pay them. And we got another question about that. When I pay them in January, that's going to be a cash entry, but no cash right now. I'm estimating, we got about $9,800 worth of wages. So I'm debiting the expense and I'm crediting the payable. All right, so that's our entry. That's what it looks like. That's what it feels like, smells like, tastes like. And yes, the expenses are going to go first, typically, when I debit those. But the credit, did our wages payable go up or down? Well, our wage expense went up. We know that. Did our wages payable go up? Well, yeah, our payable went up too. We owe the money. We haven't paid it yet. We're going to pay it in January. We're going to pay that $9,800 plus some. We're going to put some January wages in there too when we write the check. So the only answer could be debit the salary expense for $9,800, credit payable, and wages payable or salaries payable. Same thing. Just what we just described. Okay. By the way, if I go through these too fast and you have some questions, flag me down. Let's go ahead and take a look at the next question. We're trying to figure out office supplies. And we've already done this before. We're going to actually draw the T account. We had a beginning balance, office supplies. Beginning balance, in this case, was 382. We have an ending balance, 102. We didn't have any purchases, but we are trying to figure out how much we used up. So we started with some $382 worth of stuff. We ended up with $102 worth of stuff. How much did we use up in the middle of that? And so the number comes out to something like 280. That's probably a good number to hang your hat on. And this is office supplies inventory. And you remember the formula we used? We had beginning balance plus purchases minus what was used equals ending balance. Okay. And all we need to do is calculate use, or we call it X. Calculate for X. We got fancy. So what happens? We figure it was $280. So we get a debit to 280 and a credit to 280. And in this case, just like we did in the last one, this will be expense. It's going to be debited. So we got office supplies expense. We get the actual supplies inventory or supplies credited. So what does that look like? There we go. There's the entry. That's the flow. That's the process. Hopefully we're making sense. We're on the same page. Number 3. Calculate the current assets for Wicked Wicker. Okay, right. Current assets, current liabilities. Current assets, we had the definition of 1 year. We saw it in our Ben and Boz videos. We saw it in any other videos we've talked about. We've seen it in class. Current is 1 year of the operating cycle, whichever ever longer, but we're using 1 year. So what are these things are current assets? So I look down here, is cash going to be consumed in a year or used? Yeah. Receivables collected in a year? Sure. Prepaid insurance used up in a year? Sure. Equipment, is that going to last more than a year? Oh yeah, equipment, buildings, land, it better last more than a year. This is an earthquake, but we're not going to go down that path. So what's going to happen? Those are long-term, non-current assets. How about current liabilities? We have accounts payable. Yep, that'll be paid off in a year, within a year. Interest payable. Yeah, we got to pay our interest. Unearned revenue. Will we convert that to earned revenue or refund it? Yep, usually within a year. Long-term notes payable or bonds. Oh, it just said long-term, so that's non-current. Retained earnings. That's the equity stuff. So we've got 3 items that are current assets and 3 items that are current liabilities. 65, 30, and 12.2. All goes well. That totals up to 107.2. That's all our current assets. Let's go on to the next question. Let's take a look at. All right. We had 22.1 is our retained earnings balance. Is retained earnings normally a debit or credit balance? We're going to do retained earnings balance. Okay, assets, liabilities, equity. Yeah, retained earnings is normally a credit balance. So all we're saying here is we've got 22.1 sitting in retained earnings. And we're trying to calculate what's our ending retained earnings. In the meantime, we're going to add net income. We're going to reduce dividends to get to our net. And net income is revenue minus expenses. So you've seen that retained earnings formula before. Nothing fancy. You start with beginning retained earnings plus net income or minus net loss minus dividends, ending retained earnings. And we know that our net income is revenue minus expenses. Okay, how you read it, see it, or otherwise interpret it, but them's the rules. That's what we got to do here. So we start with 22.1. We're going to add our revenues of 70,000, deduct our expenses of 51.2, deduct our dividends of 11.7, and we get 29.4 as the remainder of retained earnings. That's our retained earnings statement. That's what shows up. That's the balance. That's where we end up. Let's keep reviewing. Next question. And we'll go on to we paid $21.60 on a 1-year insurance policy. What will the insurance expense on the income statement be for the first year? Well, we were told we bought it on July 1 and we're making adjustment on December 31. Now you use your fingers and toes. July, August, September, October, November, December, 6 months. So we paid for 12 months, we used up 6. Bottom line, that's half, which is 1080. And what's going to be, we're going to have to do the journal entry. I mean, here you just asked for the number. But if I was doing the adjustment, I would do the expense first, like we've been doing, insurance expense. And then I would adjust out prepaid insurance. So an asset, because I spent the money before. Credit the cash, debit the prepaid. Now I'm going to credit half the prepaid. I'm leaving half the prepaid bit still there. So what's the amount? It's what's in question. I was going to give you a depreciation question, but we really haven't talked about it. But the same thing happens. If you depreciate an asset for 6 months, you can't take a full year depreciation. You have to take a half year depreciation. If you buy something in December, you're taking 1 month depreciation. Sometimes you're depreciating every month. Sometimes just wait at the end of the year. In this case, in prepaid insurance, we just waited to the end of the year. We didn't adjust it every month. But that's all it's asking. Not a monthly adjustment, but a 6-month adjustment. Finally, we'll look at our last question. This is just asking, all right, so I recorded $2,900 in salary expense. I did the wage expense of $2,900. I did the wages payable, $2,900 in December. But what happens in January when we write the check for $6,400? Well, if we look down here, you'll see the cash is going out the door, $6,400. And this is not an adjusting journal entry. It's got cash. But that's not the question. The question is, how do you record the $6,400 payment in January? We're doing in a January entry. We're writing a check for $6,400, of which we're going to clear out the payable of $2,900 that was created on December 31st. And this year's expenses of $3,500, which were incurred in January, are going to get reported. So that's all we're doing. This one might be a little bit, it's a compound entry. This has multiple debits. It's not a simple entry. If it has multiple debits or multiple credits, a compound entry, and we're on our way. Any comments or questions? In the chat, I'm going to have you type in the following. How are you feeling? Okay. By the way, is land not included in assets? Land is included in assets. So land is an asset. We don't depreciate. We never depreciate land like buildings or equipment, but land is an asset. So, and it will not be used up in a year, so it is a long-term asset. We don't consume land like that. So, to answer your question. So, just saw it in the chat. Thank you for asking, David. Thank you for commenting and asking. Question and the answer. Go. In the chat, how do you feel about financial accounting so far? Good? Okay? Confused? Go ahead and type it in the chat, please. This is your attendance question. Type in the chat. Good? Okay? Confused? And if you're okay or confused, type in what you might be confused about. What's the most confusing thing, that most biggest challenge you're having? I'll get a feel for where you're at. What's making sense? Everything is probably a tough answer to clear up. A lot of lectures, though, you're welcome to watch. Yeah, debits and credits are a little tricky, as long as you remember left and right. That's the key. And remember the picture. That's why we have a picture. All right. So if anybody wants some help, again, take Calendly, set up a time, tutors are available, whatever we need to do to help you to get this so it makes sense. You got to practice, practice, practice. Because if you just listen to me talk about it, you might like to listen, but that's not going to get you past the test or quiz. You do the homework, that's a step in the right direction. If you practice it more and more, that's even better. And I know time is a lost art. You don't have enough time. You got to review the time requirements. Typically 6 hours outside of class, 3 hours in class time, and double it outside at 6 hours for every class you take. That's the AACSB budget. I'm saying if you're going to take class, an hour class is 2 hours outside. 2 to 1 rule that they do. And some days, some years, some weeks you can get by in 3 or 4 hours in this class, and some weeks it's going to take 8 or 9 hours. But this budget, it is about a 6 hour. You say, wait a minute, 6 plus 3, that's 9 hours. I'm taking 5 classes, that's 45 hours. And I'm working 40 hours a week. Where do I find time to study? I empathize, really. I understand. But you're paying a lot of money for tuition as well. The education, you're here to get that education. And I'm here to give you your money's worth. I mean, I know you love the class, come to class for 10 minutes, get an A, and we're done. And I'd be happy to do that if you knew the stuff. But I want to make sure you know this stuff because this is your foundation. This is your business career. And you're going to be talking to accountants even if you're not going to be one. And I want to make it solid that you're in a position that you've got some knowledge because you've got a bonus check. Say, I'm expecting a $5,000 bonus for this month. And you get a $2,800 check and you say, where's the other $2,200? I wanted to get a car. I wanted to get an engagement ring. I wanted to take a vacation. It's accounting. And if you don't understand that, well, you might have had a bonus based on net income. And we adjusted it because we took depreciation. And we have these accruals, and we adjust the wages. And then here's our real profit. I mean, it looked like we had pretty good profit on December 24th when you looked at the books. But December 31, we had all these adjustments going in. Now your bonus is cut in half. Is that frustrating? Yes. But if you understand it, you can plan for it and not take the $5,000 vacation and book it as a cruise, but understand there's going to be adjustments. Be aware that, well, here's what I can expect, and here's what I can budget, and here's what I can do for my family, or myself. So that's where we're going. That's why we're trying to figure it out. And yes, there's taxes withheld on all that too. So your $5,000 bonus is not just deductions of accruals and deferrals, it's also deductions of taxes and withholdings and federal tax and state taxes and Social Security and Medicare. Okay, and we'll get into that. We're gonna spend chapter. Make sure you have your books. Pick up the annual reports. There's still a bunch here. And if you don't have them when you come, grab a couple from the do not throw away box so you have them when I ask you, take out your annual reports. We're going to be doing some things and some group work with that. A couple of final things I want to talk about. I'm going to go back to sharing the screen and go through this final flow. I'm going to go through this adjusted trial balance. Make the screen a little bit bigger so you can see what we're talking about. So our adjusted trial balance has our chart of accounts. And all of these things there, we draw lines through them, put down to retained dividends right here. There's our balance sheet above the line, our income statement below the line. Our column for unadjusted trial balance, debits and credits. Another column for adjustments, debits and credits, our AJEs, adjustment journal entries, full list chapter. And finally, our adjusted trial balance. And eventually we close out everything from consulting and rental revenue down, those 400 series accounts, 600 series accounts. Those get closed, and we talked about income summary earlier today. And then we close the income summary to retained earnings. But I'm just worried about getting financial statements out of this stuff. And you can see that what we're doing is getting above the line our balance sheet, below the line our income statement. Here's mine. Financial statements are prepared. Income statement using revenue expenses, retained earnings from adjusted trial balance, pulling that income from step one. Prepare the balance sheet on the adjusted trial balance, assets, liabilities, equity, and then a statement of cash flows. And we're not going to get to cash flows until later in the semester. I'm emphasizing balance sheet, income statement, statement of retained earnings. But here's the big picture. Here's a statement. Here's our adjusted trial balance. And there's our balance sheet falling out. There's our retained earnings statement falling out, and our income statement falling out. The closing process, close accounts, record and post closing entries, income summary, and our post-closing trial balance, which only includes those permanent accounts. Our trial balance has a temporary accounts, income statement accounts, and balance sheet accounts, but our post-closing trial balance is only our permanent account. Then we have our closing entries, this is that flow. Closed credit balances, the revenue accounts to income summary, debit income summary. Close the debit balances like expenses, credit income summary. Close the income summary account to retain earnings. So whatever the balance is, could be debit or credit, not positive or negative, but could be debit or credit. And then close dividends to retain earnings. That's going to be the closing entry flow. You won't be testing on it. That doesn't mean you need to close your ears and never see it again. It just means you won't be, the income summary is not tested. But this is a big picture on the closing entries. And then a post-closing trial balance is the permanent accounts only. Balance sheet must be in balance. Assets must equal liabilities plus equity. Debits must equal credits. And here's a post-closing trial balance. Balance sheet. Notice accumulated depreciation is on the asset, is under assets, but it's a contra asset. At $300 is a credit balance that shows up on a balance sheet. Asset section. Contra asset. We looked at the accounting cycle. We went through this whole cycle just an hour ago, less than an hour ago. I'm going to walk through a couple of things and then set you free. Classified balance sheet. Current assets, current liabilities. We talked about on the quiz, current assets within a year, current liabilities within a year, non-current, long-term, plant, intangibles, non-current liabilities, and equity. Current assets, expected to be sold, collected with 1 year operating cycle, long-term investments, more than a year, plant assets, also more than a year. Intangibles, copyrights, patents, usually pieces of paper. You have rights to use things and do things, trademarks, goodwill. Current liabilities, again, pay off in a year. Long-term liabilities go beyond a year. And equity, the owner's claim on the assets. Profit margin. I told you you had a 36% profit margin. Is that good or bad? It depends. Thank you. All right. Well, that's what Visa had, but a year ago they had 40%, and 2 years ago they had 46%, and MasterCard was 31%. So if MasterCard was at 36 rather than 31, they'd be thrilled. But a year ago they were much higher. We talked about Walmart, 3.5%, 4%. For every dollar of sales, they put 4 cents in their pocket. Buy $1 for a dozen eggs, they make 4 cents net. Net income, net profit. Current ratio. That's why we talk about current assets and current liabilities. Now, typically, this is a liquidity measure. So if I take my current assets, if I got $1 million in current assets and $1 million in current liabilities, I'm pretty well matched. If I have 50 million in cash and $1 million in accounts payable, and those are my only current assets and current liabilities, I got a 50-to-1 current ratio. I have a chat question for you. Would you rather have a current ratio of 1.5 or a current ratio of 50? I ask a question, ask that, everybody answer, please. Type of 1.5 or 50 or something else in the current ratio question in chat. Let's see what we got for some answers. This is still part of your attendance, your participation. 1.5 or 50. Something else. Pop it for me, please. Looking, I'm saying, what do we got? 1.5. 1.5. It depends. It depends on a bad answer, but I like the 1.5 better. Because if you've got 50 million in cash, that might be cool, and $1 million in obligations. But if I'm an investor and you're putting that money in the bank, what are you going to make them? 1% or less? I want a 5% return. I want a 10% return. Take that money. Now, if you're holding on to invest, it depends. You're holding on to buy a building, to hire more employees, to buy another business. You're investing, but you get the cash and you're hanging on to it just so you can spend it. That's cool. But if you're hanging on to it just to have a nice cushion, not so cool. Give me my money back. I'll go invest it. It's going to make 5 or 10%. I don't want 1%. I'm not greedy. I just want a little more return than 1% of my money. Okay. So good answer on the current ratio. Any other questions before I set you free? Yes.
There is a discussion post,
There is a discussion post, or is there not?
it says that we have to have.
LinkedIn, I think it's for next week. Is that when it's due? 19, okay. Scott, LinkedIn is due this on Friday, yes. Right, there's two parts. There's actually changing a profile, and there's also finding articles and posting articles and commenting on the article.
So we're just going to change.
Change a profile and I think posting your article. And then you have a chance to respond to other people's articles. Yeah, if you read the assignment, uppercase letters is if you already have a profile, you still have to get new contacts, meet new faculty. If you don't have a profile, it's upper and lowercase. So in the syllabus, it's divided. You can very easily see question one. If you don't have a profile, just do the upper and lowercase assignment. Part one also has an uppercase only, and that's if you already have a profile. So yes, if you already have a profile, we're enhancing it. We're improving it, and you're getting more involved, further networking, more connections, more opportunities. Okay, let's talk about that on Friday. I like that question, but some of you have class to get to. But it's basically, you're going to join the Accounting Student Exchange group. You're going to go into a Forbes or Fortune or Wall Street Journal article or Time Magazine, USA Today on finance, accounting, something in business, and you're going to post it into that group. And we'll do an example of that on Friday. I like that question. And when you post in that group, now anybody else that's a member of the group can see it. And now you can make comments like you do in the Facebook thread or Instagram or any other social media. You can make comments on somebody else's posts. But find something interesting. It might be about school loans. It might be about COVID, or that's getting old, but it might be about accounting, business, finance, career, interviews, those kind of questions and opportunities. Post something that you find interesting. Hopefully your classmates will find it interesting too. And we'll talk about why you might want to do that. What's that? You grab two, yeah. And make sure to pick up your annual reports. Yeah. Yeah, if you, part of your assignment was to request those annual reports. And if they were, no. Yeah, some people, for whatever reason, they weren't forwarded, they weren't sent. So I have spares here in case you need them. But yeah, if you've got yours, you don't need spares. Thank you. I thank you. So the floor is open.